My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job, educate and teach. So call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Now, if you scan the market today, you may have detected a shocking bout of rationality where profitable companies that are doing well actually saw their stocks go higher, while companies that are losing money but just have good sales data saw their stocks mutilated. Add it all up, and we had a decent session. Dow gaining 146 points. Most of it came near the end. S&P advancing 0.30%, and the NASDAQ declining 0.26%. But there's one big difference between today's winners and losers. The stocks that performed poorly used to do very well with very similar numbers like they're reporting now, while the stocks that roared had typically been left out in the cold for years doing nothing, dismissed as fuddy-duddies that simply worth, well, let's say they weren't worth owning at all. So let me give you some examples. For instance, there's an identity verification company we've had on the show for ages. It's called Okta. Now, they're the gold standard in identity management for the enterprise. They handle all your login and verification credentials. Everybody knows them. Last night, Okta reported when the numbers crossed the wire, I said, oh, look at this, usual strong revenue quarter from these guys. Okta's willing to lose money as long as they can keep generating tremendous revenue growth. That used to be a foolproof game plan. But starting last November, the market has turned against that plan. And if you thought these unprofitable growth stocks were finally getting a reprieve, Okta put that thought to a rest today when its stock lost more than a third of its value. Institutional money managers hate unprofitable companies these days, even the ones with fast growth. Whenever they see one, what they do is pretty darn simple. Sell, 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 sell. Okta is just so far away from making money that it can't be owned. Too out of style in the new Wall Street fashion show. Yep, Okta's now a pariah, along with hundreds of other companies, especially the ubiquitous and in some cases ruinous software companies that embrace the same exact strategy, pursuing revenue growth at the cost of profitability. Meanwhile, the Dow Jones Industrial Average is full of old-fashioned companies with real earnings and buybacks and dividends, and it's been holding up much better than the other major indices. Same goes for the dividend aristocrats we profiled earlier this week, not to mention most of the stocks we own for the charitable trust, which you can follow by joining the CNBC Investing Club members-only morning meeting at 10:20 a.m. every day, all you need to know. But now we're several months into this strange dichotomy between fast-growing companies that are now money losers and slower growth companies that are still profitable. Wall Street now, well, let's just say, it loves the latter and loathes the former. And you know what? A lot of people still don't get it. There's an incredulous group of CEOs I speak to regularly who simply can't believe their eyes. They still think investors want growth at any cost, that people want to hear about their land and expand tactics, that anyone still cares about their first mover advantage or their top-notch go-to-market strategy with all sorts of new logos. They can't admit to themselves that the only thing investors want to hear right now is actual profits, not non-GAAP adjusted earnings, because that would mean slamming the brakes on the growth strategies that worked so well for them until late fall. They don't know anything else other than what the venture capitalists taught them. They don't know how to make money. They think making money is losing money. These executives need to get serious. They have to start finding a way to make money. I feel like I'm sending, you know what, I ought to send him a copy of Only the Paranoid Survive by the late, great Andy Grove, the man who built Intel into the powerhouse it used to be. Best business book I've ever read. Grove devotes chapters to the need to make money for shareholders while holding yourself accountable. Grove was a throwback compared to most of these money-losing CEOs who try to judge themselves based on weird forms of earnings reports that are as tortured and superfluous as the novelistic reports we used to get from General Electric in the old bad days. I always thought that Faulkner wrote them. I'm going over this. Why? Because all of this started changing last November. Now it's really coming to a head. The market has changed its attitude. Now it's to the fore. Profitability is in. Endless losses are out. Makes sense, doesn't it? Like I say, hey, if you're in your household and all you do is lose money, well, I don't know. I like a household that makes money. And last Friday, Fed Chief Jay Powell made it clear that this is the new normal for the foreseeable future. That's another one of the subtexts. There were many from that speech in Jackson Hole. Let's get some points down that you can really, some fine points you'll remember. First, there's a practical element because it's become much harder for marginal companies to raise money. All right, the IPO market is frozen. There's little demand for secondary offerings where these companies can raise more money, and the bond guys have no patience for any of these outfits. So there simply isn't enough money going around for this legion of unprofitable companies to keep funding themselves. There's no longer a pot of gold at the end of the rainbow. Hey, we had a rainbow over our house the other day, and from what I could tell, the only thing at the end of it was I-95. Second, these companies all seem to have been taken public by a handful of venture capital firms that were powerful enough to jam them down the throats of cooperative investment bankers and willing to be fooled investors. They love, by the way, they're addicted to software companies. Ooh, if it's software, they love it. The venture capitalists were sources of such great wealth that the bankers really couldn't say no, which is why they rubber stamped practically everything that wanted to go public. But now these newly public companies are talking about how it's gotten tougher to close deals, or clients are more measured with their spending, or sales cycles have gotten elongated, which translates into disappointing forecasts down the road, and those in turn lead to lower stock prices. And as the shares go down, the employees start leaving because they're often paid in now underwater stock options. It's a vicious cycle that the Fed actually, yes, wants to occur. They just don't say it out loud. Third, investors simply don't understand what many of these companies even do. Nobody cared when their stocks were going up. But now that they've spent months going down, people want to know, did I eat Octa for breakfast? Is that what I had? Did you see some snowflake? It's the summer. How incredible. I mean, that's what they know. That's what they know about these companies, okay? There are too many enterprises offering digital on-ramps that can control your data, then silo, digest, analyze, and monetize it. I'll tell you what. You know what we're sick of? We're sick of Bob Dylan companies. You know, the ones that aren't looking to block you up, dock you up, rock you up, lock you up, analyze you, categorize you, finalize you, or advertise you. All I really want to do, yeah, baby, is make money with you. All right, I took some liberties with the last line. But this show's about making money, not making friends. Now, there are oddities. Today was still one more day where the price of gasoline went down, which means the old oil companies were having a hard time making money. Hey, but it's great for the stock market. As long as the price of crude stays above 80, the dividends of these companies are so big that the oil stocks are hard to take down. At the very least, they don't get hit as hard as you'd expect. But more important, I mean, one of the things we need to see is gasoline coming down, right? If you're the Fed be winning on that one. We also see the wrath of the U.S. government spilling into the world with semiconductors. Our leaders no longer want China to have access to our best artificial intelligence chips. We don't want the People's Liberation Army using them against us. That crushed the stock of NVIDIA. They're going to take a $400 million hit from these new restrictions. And that's just this quarter. More on that later. And we have plenty of companies that are still dealing with meme stock hangovers. Now, I was thinking, if you want to bet against the memesters because they're just such nice people whom I love so much and can't wait to take out to a ball game, you can go long Best Buy and short Bed Bath & Beyond. Ideally pleased with puts and calls. Could be a great trade that closes out on the Christmas season. And you know what? If the memesters win, yeah. Overall, though, this market's preparing itself for a J. Powell nuclear winter, kind of like a Chernobyl affair, where the cloud coming off the reactor 4 to be specific, is one you don't want to be in. And any company that's involved in the cloud needs to be decontaminated before it irradiates your portfolio. Bottom line, it is an unforgiving time. We're back to the dynamic that defined January through mid-June. So don't be a hero right now, because there's no telling how low some of these unprofitable stocks can go. But be happy that we're finally so oversold that the good stocks are going to start winning. I need to start with Ari in Michigan. Ari!
Booyah, Jim! Thanks for taking my
Booyah.
call. So I'm
What's going on?
So I'm thinking of opening a position in Exxon, Occidental Petroleum, or Kinder Morgan. And I was wondering what you'd recommend as the best play to get in on the liquefied natural gas trade.
Great question. Occidental up too much because Warren Buffett keeps buying it. Exxon's already had a big move. Thank you, David Faber. That leaves me with Kinder Morgan because I do believe in pipelines, and a lot of guys have downgraded. I think that's a mistake. Let's go to William in Michigan. William.
Hi, Jim. Thank you for taking my call.
Of course.
As we start the historically worst month of the year and with inflation on its way down, we know there will be additional rate hikes in the near future. Along with the upcoming holiday season, I would like to get your opinion on Mattel.
All right, so I like the stock of Mattel very much. The one thing that, I like the company, the stock has pulled back here. This is your break. It's pulled back just a couple points from 27 to 22, and I say, buy, buy, buy. How about we go to Mario in Illinois? Mario.
Jimmy, thanks for taking my call. First time, long time club member.
Fantastic. What's going on?
I was gifted Walgreens a long time ago. Now it's been cut in half. It's about 12% of my portfolio. So I'm asking, should I let it ride and collect the 5% dividend or scale out of it and use it as a source of funds for something else you may suggest?
I want you to stay around a bit, use it as a source of funds. I also want some answers about why it's such an unpleasant experience every time I go to one. And why do I have to wait forever for someone to be able to come over because I want to buy a Gillette razor blade? That's got to stop. The whole idea that you got to buzz to get someone to open a plastic thing so that you can spend $3.82, that doesn't work with me. All right, remember, this is now an unforgiving market. Don't try to be a hero. But remember, we're now oversold enough that you can buy profitable companies. Now, there is no telling, though, how low the unprofitable companies can go. Oh, man, tonight, a diamond in the rough? Well, that could be Signet Jewelers, right? Parent company of K Jewelers, Zales, and Jared plunged today after a pretty disappointing quarter. I don't know. I want to look through this thing by sitting down with the CEO, get some more color of results. Then navigating a volatile market like this can be overwhelming. So tonight, I'm opening the phone lines for a round of MI Diversified to help you prepare your portfolio for any environment. And Motorola has come a long way from making those Razr cell phones everyone used to have. I'm sitting down with the CEO of the new and improved Motorola Solutions to talk about the company's transformation, and a lot of it's got to do with software and public safety. I say I like what I hear, and I want you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.